A sharp rise in unemployment in both Germany and France is pushing the ECB ever closer to yet another rate cut in the next couple of weeks. Even as policymakers are reluctant, the economy is leaving them no choice. It's the same thing that we saw in Australia just last week, and now New Zealand, also New Zealand just today. The global race to the bottom is less of a race and more so just economic gravity. Back in Europe, the ECB's benchmark policy rate is already down at 2.25%, so another reduction gets them to 2% in the historically low interest rate level already. And remember, central banks said last year and the year before they would never go back, while markets said, well, it's only a matter of time and timing. The next and maybe only question for Europe is how far below 2% conditions will force European policymakers to go. German unemployment has been a constant problem for some time, so yet another big rise in joblessness here in May to the highest since 2010 is a big problem for policymakers. That's more than any time, including 2020. Meanwhile, the French labor market also has officials worried too, with ongoing deterioration there. Then there's New Zealand, an economy which policymakers there thought was remembering some positives after being stuck for several years in one of the worst forgot how to grow examples. Not only did RBNZ cut again last night, their own forecasts now show even more rate action yet to come, even though they don't want to do it. Even Singapore is forecasting a, quote, technical recession, something it has only suffered twice in the last 20 years. While Jay Powell continues to try to pretend that tariffs might somehow be inflationary, central bank after central bank all around the world, they're being forced by the economy to face up to reality. That's tariffs, if anything, are going to lead to less inflation, not more. More economic difficulties, rising unemployment, not less, certainly. Even those central banks that are nominally on the same side of everything as the Federal Reserve, like the Reserve Bank of Australia and the ECB to a certain extent, they're coming to grips with the hard reality of an economy that is not inflationary, that's experiencing too many pressures, and that's even before we get to 2025. As I said, the global race to the bottom and interest rates among central banks anyway, it's not really a race. They don't want to be involved in it. They said a couple years ago, we'll never do this again, only to turn around and do it because they're forced to it. It's not a race, it's gravity. We've been heading in this direction, the forgot how to grow economy that may be, with tariffs or without tariffs, remembering how to do worse. That's certainly the case in Germany. What the Germans reported was for the month of May, keep that in mind, this isn't April, this isn't March, this is here in May. The number of unemployed persons in Germany soared by 34,000 in May alone. Economists had been expected it would increase only by 10,000, and that's the most in any single month going back to 2022 when unemployment spiked largely on Ukrainian refugees. The total level of unemployed persons in Germany now is just barely under 3 million. That's at 2.963 million. That's more than any month in 2020. And it's the highest since 2010. You're talking about 15 years ago in the early aftermath of the Great Recession. And while Germany's adjusted and seasonally adjusted unemployment rate held at 6.3%, which matched consensus, there were only 634,000 vacancies in the country during May, which was 67,000 fewer than the same month of 2024, at least according to the German government agency. So a huge reduction in those who have jobs and a huge reduction in companies who want people to hire people for jobs. It's a labor market that's been sick for quite some time already, going back to 2022. The forgot how to grow economy in Germany being one of the best examples of it. And now we're seeing the economic fallout and rising joblessness that just continues to rise. No matter how many times economists keep telling us, and policymakers too, that Germany has turned a corner and don't worry about it. We've got this next plan that'll get us out of it. It never does because gravity, like gravity, the German economy keeps getting pulled further and further and further into forgot how to grow at the very best. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store of value hedge for years. In fact, it's the ultimate error hedge. While gold prices are at an all-time high, price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. When the price of gold increases, so does the cost to store it and insure it. Don't lose money owning gold, earn a yield on it instead. And Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program. And you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. As the Wall Street Journal reported, Germany's unemployment numbers rose this month as major firms intensify plans to rejig their workforces in an uncertain economic environment. That's the point. It's not more uncertain, it's actually becoming less uncertain. It's playing exactly to pattern. That's what the gravity is showing you, exactly how the German economy has been and will continue to perform. It continues to deteriorate, not as some kind of surprise or response to uncertainty. It's becoming more certain that this is the best case for Germany and that there are only downside risks as additional pressures keep coming up. In the last month, Frankfurt-listed companies Bayer and ProSiebenSat.1 announced job cuts as part of strategic overhauls. Car parts supplier Robert Bosch also said at its full-year earnings announcement in May that it anticipated employee numbers would continue to fall, having said in 2024 that it would slash 5,500 jobs over the coming years, which we talked about in a previous video last year. Quote, the German labor market continues to lack momentum at the moment, at least according to Deutsche Bank economist Mark Schattenberg, and as he said in a note to clients, there's hardly a trace of the traditional revival that comes in the spring. And early labor market indicators don't yet signal a clear trend reversal for the coming months either, which is, again, another example of this economic gravity. They impoverished the entire world in 2020 and 2021, and now everyone has to live with the consequences. For the last several years, those consequences have been forgot how to grow. But now the signs are, in Germany anyway, the unemployment problem has risen so much already. You wonder how much, from the economics and policymakers' perspective, you're thinking, how much worse can it get? But yet it continues to get worse and worse and worse. More certain to the downside, not less certain. So after the impoverishment that forgot how to grow, what comes next is not robust recovery. And that's kind of the warning sign that we're now getting from Europe's number 2 economy, France. France has been increasingly in trouble since the first quarter of last year, too. Remember the March-April inflection in 2024 that we saw everywhere. We see it here in France, especially in its labor market. In the second quarter of last year, French payrolls declined slightly, and while they rebounded in the third quarter, it was the introduction and a rolling over to French payrolls. After the third quarter, when non-farm employment hit its record high of 27.16 million, jobs fell by 0.4% quarter over quarter in the fourth quarter, down to about 27.1 million, and then another 0.1% in the first quarter of this year, at least according to the latest update from the French government. That's a loss of another 28,700 jobs, down to just barely more than 27 million. What the government had said previously is they were expecting payrolls to be flat to slightly higher. That was just a couple weeks ago. Now they're saying, well, there was actually more of a job loss. And the primary problem in France, while it's the same thing as anywhere else around the world, consumption. France looks more like Japan than not in that respect. The French consumers have not been able to spend because they were impoverished all those years ago. So as French consumers are impoverished, they're not spending, and economists keep wondering, why aren't they spending? The central banks are lowering rates and consumer price rates are going down. And the answer is found in French grocery stores. As Le Monde reported, consumers have only one priority, and that's to have food on their plates, observed Michael Biro, who's Lidl's number 2 in France. And they do so with canned tuna rather than salmon and minced beef rather than rib steak. In his opinion, One figure in the sales of the company's more than 1,600 supermarkets in France illustrates the difficulty French people have in making ends meet. The popularity of flash sales, with power tools, food processors, and textiles at knockdown prices. The population is not feeling the significant slowdown in inflation, said Emmanuel Laroche, who's a general delegate of the Procos Federation for the Promotion of Specialized Trade, which brings together 310 chains and 60,000 stores in DIY and furniture. In food superstores, prices are still 20% higher than in 2021, said Emily Meyer, who's a research director at Circana Institute, which collects checkout data transmitted by supermarket chains. And here's the money quote. Prices have climbed faster than paychecks. Thank you, Captain Obvious. Again, we see this all over the world, not just Germany and France. The entire world was impoverished by the price changes and then the lack of labor market and economic growth thereafter. Everyone lost all that purchasing power. Wages and pay and incomes did not keep up with prices, which means that over time, the economy is going to be dragged down. That's the financial and economic gravity. Price changes the economy couldn't absorb because of the original problem, which was the pandemic and the lockdowns and the response to it, the government response to it that distorted everything else. We now have to pay for those distortions, which include a lack of actual and legitimate recovery. So the economy keeps getting pulled lower and lower and lower by that impoverishment. It's that simple. And while many media outlets try to blame electoral uncertainty and political uncertainty and every other kind of uncertainty, as I keep saying, this is not uncertain, it's becoming increasingly certain. The economy's been pulled lower by all the fundamentals that the markets have been warning about, not inflation, but the past phase shift and price shock that now with labor markets increasingly difficult and shut off, what that means is quite simply French households, like their German counterparts, and American consumers and Canadian consumers and Japanese consumers, they all realize the lost purchasing power that they lost several years ago, there's no way to get that back. And any further increases in prices, especially a one-time shock, is only going to make everything that much worse. So for the ECB, while they're still worried that tariffs might ignite some inflationary pressures, they're leaning more and more toward hardship, the hardship that we're seeing, especially in Germany and France. And that's exactly what the ECB finally started to recognize last year when, you remember, they began cutting rates in June, said they were going to go slowly, but by September, they were to one cut every meeting. And by the end of the year, they were accelerating, talking about 50s, getting all the way down to 2.25%, where they sit right now. So the risks, according to the ECB, aren't really for higher prices. It's actually for lower prices and the opposite of what Powell and the FOMC are claiming. More and more central bankers are starting to see it the same way as the markets do. As Bloomberg reported a couple days ago, there's a growing danger that inflation will fall short of the ECB's 2% target, at least according to Governing Council member Gediminas Simkus. I see scope for an interest rate reduction at the next meeting in June, Simkus told reporters in Vilnius. The risks that inflation will be below the goal in the future have increased. And that's what the German employment and French employment numbers all point to. The deterioration, the gravity in the real economy, that raised downside risk that much more. The certainty is that at best you forgot how to grow, with some potential further downside on top. That's where the markets are pointing at. Germany's bond rates. Germany's 2-year rate continues to ratchet lower. It was the first to hit the global bond rally back in September, not October, but September of 2023, from above 3%. And I mean, it never even got close to where the ECB ended up. But from above 3% in the initial stage of the global bond rally, it was down to 2.5%, then perked back up and picked back up to 3% by May of last year, before dropping last summer with all of the recessionary difficulties that show up, got down to around 2%, where it was pretty steady from last summer right on through until April of this year. The liquidations and deflationary outbreak wasn't tariff uncertainty, it was more problems than the global economy could really withstand, and the market really picking up on those difficulties and the consequences from them. Since early April, the German 2-year shots is down around the 1.75% area, where it's kind of remains sort of like the Treasury 2-year that I pointed out in a video last week, where the 2-year spot on the yield curve all across the global bond market has been an indication of what the market thinks of these global fundamentals. There's your gravity. So just like the treasury market, you got the 2-year spot on the yield curve relatively steady. Again, there's your fundamentals. Well, the 10-year has been, the yield curve is steepening in Germany just like treasuries. It's not about being afraid of the government's debt, because the German government credit profile is nothing like Uncle Sam's. And we see this all over the world in bond markets, government bond markets, beside just Germany's and the US treasuries. So even as the 10-year steepens somewhat in the German market, like in the treasury market, it's really nothing more than what we've seen in periods like this, such as I pointed out before, even late 2008 and early 2009. You saw the 10-year steepen relative to the 2-year, where the 2-year continued to move lower. The 10-year actually started to move higher in early 2009. But even so, the 10-year in Germany has been moving lower since the early part of March, when Berlin shocked everyone with its removing of the debt brake and the plans and announced plans and intentions to increase government spending. The German 10-year has been moving lower pretty steadily since then, along with other bond rates. So it's not really fears over government debt levels, it's just regular yield curve mechanics. And we see in Euribor futures, for example, the market is saying that sub 2% rates from the ECB are nearly a lock. Nothing's ever 100%, but this is about as close as it gets, with a high chance of the ECB being forced down to, if not below, the 1% level, because if conditions continue to deteriorate, especially in the labor markets, what's that going to mean? Policymakers are going to continue to chase economic weakness, because their policy rate cuts are nothing more than a reaction to that weakness. Exactly what they've been so far. That's New Zealand. Just like Germany, the New Zealand economy has been a very good, if not the perfect example of forgot how to grow and a moderate variation from it. Like the economy in Europe, the US, and everywhere else, it started to forget how to grow in the third quarter of 2022. And just like Germany was basically sideways, it doesn't look like a recession, at least what everybody has in their mind of recession, until, unlike Germany, in New Zealand, the middle quarters of last year, the second and third quarter of last year, GDP fell sharply by more than 1% in each of those 2 quarters. So a very significant fall off, something that actually did look like a traditional recession in New Zealand. So they did have a forgot how to grow economy for a couple years, then a traditional recession, and it looked like, at least for 1 quarter when GDP turned positive to finish up last year, that New Zealand had found its way out of it. But as we're seeing, even the Reserve Bank of New Zealand has to admit that the downside risks are more than just downside risks. So the Reserve Bank of New Zealand brought its interest rates down to 3.5% before it got to today, saying the last time that they hoped that they were done, or at least maybe 3.25% would be the bottom, because, as I said, they all believe that the 1 quarter increase of GDP, that rebound there, represented a turnaround and the start of recovery, when there's really no reason to believe that. So earlier today, RBNZ voted for another 25 basis point rate reduction, which brings the cumulative total since last August to 225 basis points. But now they're forecasting that maybe there could be another rate cut, possibly 2, over the next little while, which is slightly more than what they were forecasting at their last meeting. And what the next step is at the next meeting, it will be dependent on developments, in particular what those developments mean for the medium-term inflation pressure in New Zealand. That's at least according to temporary acting governor Christian Hawkesby, what he said in his press conference. But one of the things that stood out in the Reserve Bank of New Zealand's statement that accompanied the rate reduction, what it said was, recent developments in the international economy are expected to reduce global economic growth. Both tariffs and increased policy uncertainty, there's that uncertainty again, overseas, are expected to moderate New Zealand's economic recovery, meaning slow it down, if not reverse it entirely, again, the gravity, and reduce medium-term inflation pressures. In other words, it's going to slow the economy, and rather than reignite some kind of inflation like 2021 or 2022, the supply shock, the reduction in economic activity will reduce consumer price rates even more, because the globally synchronized economic environment is not for restarted, reignited inflation. It's for this gravity. It's forgot how to grow at the very least. So we've got worsening employment in Europe, which is a no-brainer for the ECB. The market expects it to lower policy rates. Policymakers expect the same thing. They're all saying, well, we're worried about inflation. We're really not. The risks from tariff, if anything, are in the economy, spiking unemployment, and in unemployment spreading far beyond just the core of Germany and France. The Fed is increasingly isolated in its position that trade wars will be inflationary. Even those central banks that might agree with them are being forced by reality to confront a very different set of circumstances in reality. New Zealand was trying to recover, showing some signs of doing so, but now they're saying they're worried about getting plunged right back into the same thing, which is where the gravity is really pulling them down. And even Singapore saying, hold up here, we don't like where things are going. So rates worldwide are heading lower because that's where the economic fundamentals are. Not inflation, not in higher for longer, but in an economy that has forgot how to grow for several years and showing more and more signs of increasing weakness on top of all that. The Fed isn't going to be able to resist for all that much longer because the fundamentals apply here as much as everywhere else. Forgot how to grow. When that's the best case, lower interest rates are the base case. Right next door to New Zealand, Australia. The Reserve Bank of Australia, formerly a hawkish central bank, came out and told the press we even talked about a 50. And I talked about what all of that meant in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.